Good evening, everybody. It is 6 o'clock in New York, 5 o'clock in Chicago, March 22nd, 2020. For those of you guys who do not know me, my name is Jack Gleason. I am a futures and derivative trader, and I've been involved in the markets for 12 years. The purpose of this webinar is to go over the history of the markets to help anticipate and understand what is currently going on. We have a historical move and a historical event that is truly unprecedented. And as many of you are aware, the stock market is in one of the most aggressive sell offs in the history of that market. So, with that being said, the purpose of what I want you guys to learn and take from this webinar is understanding, looking back into time, how the market moves, and how we can take advantage of those moves in the market to anticipate where we are most likely to go. I do want to start off with the first thing I'm going to show you guys here. This is a chart of the business cycles throughout the history of the United States. Basically, each one of these lines represents the end of a business cycle. Now, this chart was last updated in 2016, but you can see through these lines when we have recessions or sell-offs in the market, how far we go down. And this goes all the way back to the 30s. Our last two true recessions, we had in 2000 a 50% sell-off, and in 2007 we had a 56% sell-off. The purpose of showing you guys this chart is to understand how the market works in the waves that it forms. I am going to review first, and then we'll go into some data points. All of the data points I'm going to be showing you guys are facts. I'm going to try to leave my opinions about the market out of this and just refer to the facts. You are looking at a monthly chart that goes back to 1928 of the S&P 500. For those of you guys who are not familiar with trading, each one of the bars on my screen represents 1 month of time. I'm going to scroll back to what is the sell-off of the Great Depression. Okay, so we're going to go back all the way to the 30s. This is the stock market during the Great Depression. And the move we are currently having in the markets is actually more aggressive than the move we had during the Great Depression. The initial sell-off has been at a faster speed now than what we saw during the Great Depression. So they're just once again, these are historical facts. These are not opinions. Coming out of that initial sell-off, and one of the things that I teach and use is these patterns that have existed throughout time in the history of the markets that determine where we will go next. This is the initial sell-off of 1929, and then we ran into what's called a full 50% retracement, or a halfway back for those of you guys who are familiar with my trading style. That halfway back gave us downside targets at 14. Okay, so this was the first downside target that produced after the initial sell-off during the Great Depression. We continued very well through those profit targets and did not make a bottom till 3 years later. So that's very important moving forward. Now, what I want to show you is what we have recently had and how this pattern still holds true. You know, we're 90 years past the Great Depression, and these patterns still exist in the market. This is the S&P 500. Our sell-off in all-time high began, it was February 19th. Okay, we're almost a month into this sell-off, and the market's down over 35%. Our first entry onto the short trend was right here. Okay, so just like the Great Depression, you had an initial move lower, and then we run into what is a 50% retracement. This is where institutions put on positions to hedge their profits that prevent them from losing any more money. They sell to cover losses and hedge their positions. This is the same pattern that we've seen throughout history and throughout time, going back over 100 years. Now, moving back out to what is in our lifetime, at least, or most people's lifetimes, we're going to go to a monthly chart. All the way back. So the Great Depression lows are $4.41 in the S&P 500. We right now, and this is not an updated price, this is from Friday. In fact, the futures market has just opened and the market is down another 5% in what's considered a lock limit down. They just opened the market and they shut it down within 5 minutes because we have just limited down 5%, which is as far as they will let the market go during the after hours, and then they shut it off. So they already, within 5 minutes, just shut off the stock market. The Great Depression low too high is what we ran into in both the crash of 2000, and you can see it's not necessarily policy or it's not necessarily economic events, but it is price patterns that create support in the indexes. And you can clearly see that the bottom of these are called candlesticks, the bottom of these wicks came into the market and acted as support after the tech bubble. That, I mean, if you look at the tech bubble, that bubble burst in 2000 and we did not stop selling off until 2002. Things are happening at a much faster speed right now, but the tech bubble, or I should say the real estate bubble of 2000, the late 2000s that popped, really the real estate bubble popped in 2006, but the market started selling off and seeing the price destruction in 2008 and 2009 when we had those government intervention programs, federal fund rate cuts, but the market once again did not bottom until the market was cut in half. So this happened in 2002. When the market got cut in half, this happened in 2009. The full 50% retracement from that Great Depression low to our most recent high, the all-time high of the stock market, is down here at 1700. That would be where the market would fall to, or the S&P 500 would fall to, if we follow the same pattern of 2000, if we follow the same pattern of 2008. So that right now, as of Friday's close, would be another 600 points lower in the S&P 500. And at that point in time, at 1700, the market's total value would officially be cut in half. So that's just something to be aware of. Now, one of the other things I want to explain, and we're going to go into the sell-off of 2008 and what that looked like on a chart. And I'll show you guys how these patterns play out over time. Because it's not just, these are not random patterns, these are patterns that exist historically, and these are the patterns that I use to trade off of. So we're going to go back to 2008, and that is right here. Each one of these bars you see on my chart, oops, that is not, yeah, here we are, 2008. Each one of these bars on my chart now represents a day of time, a day of price action. The market topped in October of 2007, and then the crash really started a while after. Now this crash, people still had their jobs in this crash. Okay, every crash is different, but our first full 50% retracement in 2008 traded and then completed its profit target. It traded its entry in May. It completed its profit target in September. So once again, the time at which we were selling off was actually much slower than it is right now. That high to low would have been the third wave of selling, where you can see we run up into that full 50% retracement, and then we complete our profit targets. After we complete profit targets, we have that previous high to low, and once again, sellers come in at the 50% retracement and then complete profit targets. So in 2008 into the 2009 lows, the lows were March 6th of 2009. We had 4 moves complete their short targets before we finally, the 5th move, the trend officially broke, the short trend officially broke on April 6th. So there was a month difference between when the target was hit and when the upside begins being confirmed when you start breaking this trend above these yellow lines. So that's just a historical reference of the price action of the market and how the market works. Now, we have potentially a long way down to go still. And I don't mean to scare anybody, but these are just things you need to understand. I am now going to move on to what is a historical chart related to the policies of both the federal government through Congress and the acts that they have given and passed, the bills, and then we're going to talk about the way that the federal bank or the Federal Reserve Bank actually does interest rate cycles. So if you look at the bailout of 2008, okay, we are about to see something similar that's actually going to make this look like a walk in the park. Okay, in 2008, obviously, you had banks failing, and then Congress passed what was considered the Emergency Economic Stabilization Act, and I have these marked up here on this chart. This was the '08 bailout, okay? And it wasn't the government stepping into the market with liquidity and providing money to the markets that made the market bottom. So you will be seeing a lot of news related over the next week or two related to whatever they're going to do. I believe Trump is supposed to speak about what Congress is trying to put together. But I have heard, and there's reports right now of a bailout of up to $4 trillion. Well, to put that into perspective, the bailout of 2008, when legitimate banks were failing, was $700 billion. So even on the low end, they're saying $2 trillion. So this is, 3 times. This bailout is most likely going to be 3 times larger than the bailout of 2008, and that just kind of shows the magnitude of what we are dealing with. Now, all the way down, the Fed was cutting the interest rates, similar to what they're doing now. One of the policy actions that the federal government takes, or the federal bank, they cut interest rates as low as possible. The last rate cut that we had also was not the bottom of the market. So it's, once again, I'm just trying to show you guys that even though, what most people would think to be good news, like the bailout or the final rate cut, does not actually signify a bottom. Okay, the bottom happened, in fact, 3 months after the last rate cut, and I think 5 months after the bailout. All right. So the last time up until recently that the Fed cut rates was December, I think it was December 8th, 2008. Coming out of the quote-unquote Great Recession, the market had no new interest rate decision policies. They left basically rates unchanged. They did not begin raising rates. The Fed was saying they were going to raise rates, normalize interest rate policy, and return to a historical standard of higher interest rates so savers could make money. And this is the first time it was December of 2015, December 16th of 2015, that the Fed had decided to start raising interest rates. So this is the Fed coming out of the decision to cut rates. At this point in time, they think the economy is strong enough and that the economy can withstand rates. So these green lines are all interest rate increases out of 0.25%. Out of 0.25%. Now, you will see we had a rate cut here rate increase in December of 2015. We had our next one in 2016, about a year later, and then after that, the Fed started hiking more aggressively. The Fed hiked in March of 2017. The Fed then hiked in June of 2017. The Fed hiked again December of 2017. The Fed did another hike on March of 2018, and then June of 2018, and then the final rate hike was September of 2018. This is the last time the Fed hiked rates, and this is when the market freaked out. This is at the time all-time highs. The market got a rate hike, and then the market freaked out. Now, the market continued to aggressively sell off until they decided, the federal bank decided that there is no more rate cuts. They basically stopped the market from selling off. And here's an article from that time frame. Okay, this is December 23rd, 2018. This is the Christmas panic of 2018. One of the things I want you guys to understand here is that the Fed will act. The Fed acts at technical levels. The Fed understands these patterns. We were coming into what was the halfway back, as I explained earlier, the 50% retracement from the low of 2016 to high. Okay, that's that middle line right there, that dashed line. As the 50% retracement of 2016 came into play, that's when you had the Treasury Secretary Mnuchin call up all of the big banks and promise liquidity. Well, the market began rallying. They really liked that news. Now, going out of these, previously, the Fed will hike in strong economic times, and then when they reversed their policy, not only did the Fed stop hiking rates, but the Fed actually began cutting rates. They began lowering the interest rate, and this was considered at the time a mid-cycle adjustment. Okay, a mid-cycle adjustment just means, hey, we're not going into a recession. We're just going to step in and cut rates to keep things going. Well, what was going on from the point at which they basically stopped or started raising rates, and this is a graph from the Fed, the St. Louis Fed. This is government data, okay? This is not a meme off the internet. There was a divergence in what is the S&P 500, which is the red line, and the monetary base, so the amount of money in the system. When the Fed started hiking rates, there was basically they are taking money out of the system, and that's what creates this divergence. The market continued higher as the Fed was pulling liquidity from the market until basically the point where we're at now, where the market has reacted. This chart right here, or this page, are all of these rate cuts, and all of these Fed decisions that I have marked up on the chart. When Jerome Powell decided to begin cutting rates, the market got a little more boost of confidence, but we have now gotten to the point where rate cuts no longer matter, and government stimulus really isn't going to matter. And the problem is in this graph right here. And this is a graph created by a federal bank governor. This is data on what the market really looks like behind the scenes, what the plumbing of the market really looks like behind the scenes. There are an estimated I can't imagine this number, but $1 quadrillion of derivatives. Okay, this is the problem with the financial system right now, and why the Fed is putting in so much money. There is $1 quadrillion of derivatives. Inside of that $1 quadrillion of derivatives, there is $300 trillion worth of private businesses in real estate. Inside of that, there is securitized debt and stocks, which is $116 trillion. Government bonds, $56 trillion. The bank money, how much the amount of money banks have, $50 trillion, and then the monetary base, $28 trillion, and then at the bottom is precious metals. In times of crises, you will see money flow from here to here to here to here. Each one of these is more secure than the next. The least secure is the derivatives market. This is what happened recently. Okay, this is the Federal Reserve FOMC policy statement that we have started to see. And I want to show you guys, we've been having drastic Fed moves that are incredibly aggressive. Now, what was interesting is this, at this point, which was February 28th, that is when they tried to stop the market. This is the first time on this recent sell-off where the Fed decided to step in and stop the market. The problem is this time it didn't work. And I'm going to show you why it didn't work and what I mean when I say that. So I have explained how the market trades in these patterns of full 50% retracements. So we had the low of 2016 to what was at the time the high of 2018. The Fed stepped in, it worked. The profit targets off of that level were completed at the end of the year. They actually completed at the end of the year. Okay, what happened next? Well, that low towards the end of 2019 to that most recent high traded. Okay, and I'm just going to delete this line right here. Okay, we came into what is considered the support level, which is just a pullback. This is when Jerome Powell came out with the statement 30 minutes before the market closed on Friday, February 28th, and said that the Fed is willing to step in and basically back the market. They're going to do some type of policy change to help the market out. Well, that policy change came the following Tuesday as the market set up in that 50% retracement short that I explained begins almost every single major sell-off. The Fed did an emergency 50 basis point rate cut. This was the first emergency rate cut in 12 years, and that happened on March 3rd. We did an emergency rate cut, the market failed to break out, and we have been selling off aggressively ever since. But basically, the break of this low to me was the end of the bull market. It is the end of a 12-year bull market. And that's another thing to understand. This is the longest business expansion in the history of America, and it lasted 12 years, and it's over. Now, I'm going to delete that just so we can see this chart a little more clear. The Fed last week on Sunday took out even more dramatic measures as basically there's credit markets freezing in the background. They have decided to launch, as of last Sunday, a week ago today, a $700 billion quantitative easing program. And all of that information can be found here. This is on the Federal Reserve's site. They are going to purchase $500 billion of Treasury securities and $200 billion of mortgage-backed securities. So the Fed is once again, just like they did back in 2008, stepping in and buying up the liquidity out of the market to prevent it from continuing lower. The Fed also last Sunday cut interest rates basically to zero with another emergency rate cut. The Fed had a scheduled meeting on Wednesday. They didn't even bother to wait 3 days. Sunday night before the market opened, they did everything they could. They threw the kitchen sink at the market. They took interest rates to zero and announced a $700 billion QE program. What happened? We got destroyed. It's not working. It's not working. This is a schedule of the repo market. So this is what goes on in the back of the market and the amount of liquidity the Fed is putting in. Now, initially, when we were doing quantitative easing round one, the Fed was doing $45 billion a month in repo operations, which is overnight liquidity for basically banks. They are now doing $500 billion a day. It's incomprehensible the amount of money they are pumping into the market. Is incomprehensible. And the incredible part is it's actually not working. You can see this is straight from the New York Fed website. This is a government website, and this is the information that they release publicly. Anybody who knows how to find this stuff can understand it. So they're doing $500 billion in repo to pull out liquidity in the market. Now, when they start adding this type of liquidity, this is a chart of what is the Federal Reserve's balance sheet. Okay, coming out of 2008, the balance sheet grew. Okay, they're taking assets onto their books. They can take unlimited assets onto the books. They started tightening. Okay? And then they realized that the market couldn't handle it. The market could not handle the tightening. The Fed began expanding its balance sheet in August of last year. The market continued to move higher, but this was your first warning sign. The Fed should not be expanding its balance sheet. What they're doing is they're providing liquidity to the market, which basically was the reason we had that super aggressive run up towards the end of 2019. Now, the coronavirus is basically the pin in the bubble, but the bubble existed before the virus, and that's the important thing to note here. This balance sheet of the Federal Reserve is about to go through the moon. It is about to see the most dramatic increase in monetary stimulus we've ever seen in the history of our lives. This is fact. Okay? The assets they're talking about right now, and it's not fact yet, but they're talking about providing the Fed with another $2 trillion. So they would take on, that would increase this balance sheet right here basically by 50%. It would be a balance sheet increase about 50%, which is absolutely incredible. This website is called usdebtclock.org. These are all facts. These are all statistics. This is the United States national debt at $23.5 trillion. These numbers on here are incomprehensible, but if you ever wanted to know what these numbers mean for every one of the U.S. citizens, the debt per citizen, all of that number is here, and it's pretty amazing. It's pretty amazing to take a look at this and to fully wrap your head around what's going on. Okay, so when the market goes into states of panic like this, people flood into the safest assets because these are all digital assets. And as the Federal Reserve increases the monetary supply, the technical value of the money goes down. Now, we are in a deflationary period because the market is going down. Real estate prices are most likely going to go down. That data in real estate cannot reflect the speed at this move, but the market is down over 35% off its highs. So we are going to go into a deflationary period where the prices of all assets fall. When the prices of all assets fall, the Fed does everything in its power to keep the price of assets higher because honestly, it's a matter of national security. And when they do that, they're most likely going to overreact and pump in like I said, as much money as possible. Eventually, when things get sorted out and the coronavirus, goes away and it's no longer an issue, you cannot reverse the amount of money they are putting in the system. If you understand, just basic economic theory, if you increase the supply of money but do not increase productivity, the absolute guaranteed result is inflation, without a doubt. And anybody who understands basic economic theory understands the situation that we're about to run into. If people aren't going into work, aren't producing goods, but you're increasing the money supply, that is a larger amount of dollars competing for a smaller amount of goods. So we're going to see an increase in inflation moving forward. And that brings us to the question of the future of the global reserve currency system. And I'm going to stay too far away from speculation on what can happen and really just show you guys history. The United States dollar is the world reserve currency. The world reserve currency is the currency of the world. It's basically where the debt of the world is. If you're taking out if you're buying oil and you're in another country, you're using the US dollar. So the US dollar right now is the most powerful currency in the world. And this has changed throughout history. Before the United States, it was Great Britain. Before Great Britain, it was France. Before France, it was the Netherlands. Before them, it was Spain. But you can see none of these have ever lasted as a world reserve currency over 110 years. Right now, we've been the world reserve currency from 1920, so we're approaching 100. This is a potential problem in the future, I believe, in our lifetimes, and it's just something to be aware of. And for the first time, and there's a lot of theories about only gold and silver, but for one of the first times in history, I think you're beginning to see people actually wake up to the idea that the market in the United States cannot print their money into infinity without ever suffering the consequences, which right now we really have not seen. But we are approaching a moment in time where history has never seen something like this. And I want to show you guys something that I think is interesting. This is a chart of silver depositories and who owns them. This chart goes back to 2010. The red line is the one I'm going to pay attention to most. That's JP Morgan Chase, one of the largest banks in the United States. In 2010, JP Morgan owned no silver. No silver. You can see they have massively been accumulating physical and hard silver ever since 2010. This chart was last updated in 2007, so it is older. But what do they know that they went from owning zero physical silver to having right now? JP Morgan has the largest stock that any institution or country has ever had in the history of the world. JP Morgan owns, which is pretty interesting. I'm not sure, I can't speculate as to why they are buying that much precious metals, but I'm just showing you that they are. Okay? And then one of the other things you are seeing here is gold and silver is selling out across the world. This is the largest silver and gold dealer for the United States, and these are their products. You can just see literally at the top, due to extreme order volumes, please expect a shipping delay and a minimum order requirement. This is temporary. This has never happened. So you are seeing what is the result. Let me find that chart of this. When there is panic in the credit markets, money flows to the safest assets. Money flows to the safest assets. And one other thing I want to point out here is these numbers. The dollar to gold ratio and the paper to silver ratio. Now there are ETFs, which are exchange traded funds that hold silver, and there are ETFs that hold gold. Those ETFs, I want you to understand, are fake. For every ounce of physical gold, 88 people think they own that same ounce in the paper markets. So this would be like an ETF like GLD. Okay, these are ETFs, and all they are is exchange. They're digital representations of the value of gold, but they don't actually trade at a one-to-one basis. So if you own a gold ETF, so do 88 other people. If you own 1 ounce of the gold in an ETF, 88 other people own that same ounce. For silver, it's 175 to 1. So the paper markets are not a real representation of the value of the hard metal. And that's something interesting that we're seeing happen right now. And that is exactly why this stuff is selling out across the world, because it is historically the only protector against inflation, which is, I think, the eventual outcome. And that is my opinion. There's no fact there. I think is the eventual outcome based on what I'm presenting to you. Now, we'll move forward just with a couple of final notes of where the market is going, in my opinion. And we're going to look once again at the SPX. And I'm just going to reference. We're going to look at the SPX, which is the S&P 500, over the course of history. And we're going to look at the Dow. So I am going to an max available monthly chart. The history of the stock market. You're looking at it right here. A 50% retracement in the S&P 500 would be, like I said, 1,700. And for the Dow, we're actually going to hit it close or faster. Let's see here. DJX. Don't know if I can pull up. I can't pull up all of that data. DJI. I'm just going to use the ETF for DJX. Basically 0 to the current high. I'm just going to go futures here. 0 to the current high. We are at the halfway back. We've already been cut in half from 2009. But the full 50% retracement from the Dow's low of the Great Depression is down near 15,000. Okay? And that's 3,000. This is not far away. I started talking about these numbers for those of you guys who follow me on Instagram weeks ago. We could be here by the end of the week, which is kind of scary. We could easily be here by the end of the week. Now, the problem and result out of all of this is yes, will the stock market go back up? Yeah, we will take out this all-time high at some point in time unless the world ends. I mean, the monetary system continues to expand. If you are creating money in mass in the way they are doing it right now, there's no doubt that money eventually finds its way into the market and moves up higher. This is the level where the Dow is cut in half, okay, at 15,000. I would not personally be a buyer of any stocks until then, but the problem is what happens after. And I think that's a massive inflationary period. So that's really the basis of what I have here. Just as a reminder for those of you guys who are watching this for the first time, I'm going to keep people updated and try to do it at least weekly, but I do a video every single morning on the movements of the markets and what's going on. So make sure if you're watching this video and you're not subscribed to my YouTube to hit that subscribe button. Also, feel free to share this video with anybody who you think might find it useful, friends, family, anybody who's involved in the market. If you're interested in getting involved in the market, I have a really basic free course here, and also you can join my trade room if you want more detailed information by becoming a member. And my website is startuptrading.com. With that being said, I'll just give this opportunity for those of you guys who are in this room to ask questions. And also I'm going to ask you guys a favor for anyone who's watched this video up until this point and has found it valuable. I encourage you to guys just hit that like button because I'd like to get this information out to anybody who thinks it is valuable. So with that being said, I will take questions. Okay, are GLD and SLV even safe in relationship to just owning gold COMEX and silver COMEX? I don't think any ETF, if you want exposure to gold, if you want exposure to silver, you buy the metal. You don't buy the ETF because the ETF is fake. There's not actual one-to-one, there's not a one-to-one backing. Okay? And we can go, and I'll show you guys, for those of you guys who are on here, this is what a limit down looks like. This is what I mean they close the market down. You see the market's down 5%, they close it. Tomorrow morning at 8:30 Chicago, 9:30 New York, the market will reopen, and the market will close again when we go down 7%, and then they'll reopen the market, and if we go down 13%, the market will close again. They'll halt it for 15 minutes. After 15 minutes, the market opens again, and if we end up down 20%, they'll close the market for the day. Right now we're through all the S&P targets that I had. There needs to be a pullback. I'm also not trying to talk like small. This is a webinar where I really want to discuss the larger point of view. I'm not interested in discussing smaller moves here. I'm only interested in discussing a larger picture. Greg says the moves thus far have matched up nicely with the VIX 50% support. Greg, the VIX, there was a firm out of Chicago called Ronin Capital. I think you saw they blew up. They blew up on a VIX trade. So I think that might have been why you saw some of the dislocation in the VIX before compared to now. It might have something to do with that firm blowing up. Grind hard trading. Why won't the market hold above the 2009 lows to highs? It might, but the last two times we went into a major pullback, we held the halfway back from zero. And I'd rather be late than early. This economic event is bigger than 2008, and it is bigger than 2000. They are expecting the largest unemployment jump in the history of America, so why would the pullback be any less deep than it was in 2008 or 2000? Why would the pullback be any less deep if the unemployment is going to skyrocket to the highest in history or since the Great Depression? I'm not going to answer questions about specific stocks. If you want specific stock questions answered, you'll have to ask me in my room. let's say the CV situation gets solved pretty quickly. Do we recover quickly? How is it going to get solved quickly? It's not going to. That's a question. How does it get solved quickly? Does it just disappear? It's not even stable. Are you thinking that there is more panic waiting at the 50% retracement? The deepest sellers are always at the lows. There's more panic to be had. The panic is absolutely not over. From the halfway back from the YM and ES, are you feeling it will be a consolidation level, or will you get a solid bump from that level? It'll be more of a consolidation. On this higher time frame, it's typically more of a consolidation, and I'm using history as a reference for that. I don't think, I don't think we're going to have, I do think there'll probably be buyers right off the bottom, but typically there's so much damage done that you don't have, the trend is officially broken. If you look at the period of 2000, the 2000 crash, we basically tested that halfway back long once, and then we made a lower low, okay? And then, boom, we ripped. I imagine we'll see a similar pattern. There'll be a bounce. There'll be one more dip. We have identical patterns in the 2008 and the 2000 crash with a initial touch of the 50 and then a new swing low that ends up being the low. We had the initial touch of the 50 here in November and then a new swing low in March before the market moved higher. Yep. Question from Stacy. Holding gold and silvers for resale when things get really serious. Yes. I mean, it is. I view the holding of physical metals as a long-term play against inflation. It is not a trade. I mean, it is a trade in a sense. You eventually trade it out. But if you look at the prices, and let's actually see where gold opened up here. Nothing too crazy. Gold. And I'm going to show you guys some 50% retracements here on gold. Gold, and this all has to do with federal policy. We actually came halfway back from, what was it, the lows of 99. The lows of 1999 to high is where gold was in an accumulation phase. Okay, once again, we traded the 50 and then we made that new swing low. Now, gold's target, just based on this calculation, is up during to 2,318. I think it will eventually go higher than that, but just based on this simple calculation, that's where that would be. This here, okay, this is very similar. In 2000, initially on a sell-off, this is 2008. Okay, let's look at this for gold. In 2008, gold sold off, right? We pulled back into a retracement. Coming out of 2008, gold tripled in price. It tripled in price from its low. When you have an all asset liquidation like we're seeing right now, which this is something that didn't happen in 2008. Silver was, you could still buy silver and gold. It was still available for sale online. These are paper contracts. These do not exist. Okay, it's just a way to trade it. There's a fractional backing system where only a fraction of the value that is held on these that is held in these contracts actually exists. Now, coming out, once they started cutting interest rates and doing the quantitative easing that we are going to see and doing the inflation, gold tripled in price. And then the Fed said they're going to cut rates. They did, and gold fell. Well, until the Fed comes out and changes their interest policy, I don't think we're going to see a bigger downtrend begin in gold. Yep. So the question is, physical gold and silver, is this also true for diamonds? No, the answer is no. Diamonds do not have a clear liquid market, which is what Greg Van wrote, which basically means diamonds are not uniform. Okay, you have a $5 million diamond and a $5 diamond. Okay, and that's based on quality. They do not hold the same properties as gold and silver. Gold and silver are historical storages of wealth going back thousands of years. Okay, so, and also new information was posted here. Senate fails to get a vote passed. This is exactly what happened in 2008. They failed to pass a vote. It's possible. We can only speculate where the price of silver could go. I mean, it's a speculation, but if you look at this usdebtclock.org, what I can tell you is historically where we have been and where we could go. If every single one of these people, so all of the people that own SLV or SI or any type of derivative, paper derivative, decided to sell their paper derivative and convert that price or convert their dollars from a market, like an ETF into physical, you have 175 people that would try to buy the same ounce. What would that do to the price of silver? 88 people own the same ounce of gold in the paper market. What would that do to the price of gold if all of these people sold their paper contracts and went out into the real world and tried to buy gold? Well, what would happen was you wouldn't be able to find it because everybody would be trying to buy it. And that's what you're seeing right now. Look at it. Go online. Look up. I encourage you all to go look and try to buy gold and silver online. Just go try to do it right now. You can't. Why is that? What are your thoughts about money on the sideline and potential? I don't think this is going to be a V-shaped recovery. What does a V-shaped recovery look like? When is the last time we had one? Was 2008 V-shaped or was it you? Was 2000 V-shaped or was it you? The problem V-shaped recoveries can only happen over shorter periods of time. The problem becomes when you run into a situation like this where we're having massive unemployments. There is so much that the market has to figure out as far as valuations. We are far, even if people go back to work tomorrow, the balance sheets of corporations and the fact that people are no longer going to be willing and able to take risks, also put on top of that, we have a demographic cliff coming up. Are the mom and pop investors, people like my parents, who are about to go into retirement, wanting to stay long the stock market after they saw their wealth cut in half in 2000, they saw their wealth cut in half in 2008, and I think most likely they're going to see it cut in half. Everybody with a Roth investment account that sees their wealth cut in half every 10 years, at what point when they get close to the retirement do they just want their cash safe? They want it out of the market. That's a potential scenario. That's an opinion, but think about it. What correction are you looking for in real estate? I have no idea. I don't follow the real estate market. I just would assume a correction. I don't know how far the market would go down in real estate. Also, real estate's a hard asset technically. Unless you're super over leveraged, then you're kind of in trouble. What are your thoughts on crude oil at this time? Oil, there is a difference between a commodity like oil and silver, or oil and gold, or oil and silver. Saudi Arabia and Russia are controlling the price of oil. No country can control the price of gold. No one's going to be like, we're going to mine more gold and we're going to flood the market with gold. Nobody can do that. Okay, Saudi Arabia says we're going to flood the market. Russia says we're going to flood the market. They're going to drop prices. It's a geopolitical game, and crude oil is, in my opinion, if you don't understand trading, it's a tough investment because there's so many price fluctuations based on like a geopolitical game where it's a lot of big countries trying to screw the other one over. What are you supposed to do with gold and silver once you have it? You can do whatever you want with it. Bury it in your backyard, put it in a safe, put it in a safety deposit if you trust the banks. But it's just a long-term store of value. It's a long-term store of value. And if we go into an inflationary period, which I could think would be the only result of the government, we've been constantly expanding our balance sheet. But if we start excessively printing, they're talking about a $4 trillion bill, that would literally turn this number at 23 trillion overnight to 27 trillion. And there is no end to this. This will not come down. This number will not get lower. It has never gotten lower. It will continue to go higher. Do you have any trend-based tools to estimate the time of the correction? Alan, I can answer those questions in my chat room. I'm just educating you guys on the history. I'm not looking to get into technical lessons here. People got to eat, so I'm going to buy a cattle. Good idea. That would be an asset that would go up during an inflationary period. But yeah, that's going to kind of wrap up this video. I don't want to make it too long. I want you guys to encourage your friends and family to watch it. We'll see how this plays out. If you're interested in learning more, guys, check out my website, Startup Trading. But unfortunately, regardless of not if you trade, regardless or not if you own investments, this is going to affect you. And inflation would affect all of us. So you need to be prepared. 2008, the crash of 2008, and seeing everybody lose their money is what got me into wanting to learn and understand the financial markets so I could avoid the pain and suffering that your average investor feels because they don't understand the market. And here we are 12 years later, and I'm avoiding the pain and suffering. And I encourage you all to learn so you can do so the next time something like this happens.